Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hey there, and welcome to the College Investor Audio Show. Today is the Beginner's Guide to Selling Put Options. So you know that a lot of traders are familiar with buying options. Buy a call if you believe the market will go up, and buy a put if you think the market will go down. In general, if the market goes above your call strike, you make a profit. And the same if it goes below your put strike. A few other variables come into play in determining if the trade will be profitable or not, especially theta, or time decay, of the option. Both of these strategies take a directional view of the market. One view needs the market to go up, while the other needs it to go down. For call buyers, if the market remains where it is or only goes up a little, their call will expire worthless, creating a loss unless they can buy it back, which will generate a smaller loss. The game of buying options is one with little margin of error. What if you could build in some margin of error so that the market doesn't have to move so much for your option to generate a profit? Shorting put options. Put selling is one such strategy. It's a strategy that isn't as familiar as option buying. Some traders know about put selling but view it as extremely risky, even going so far as to say there is unlimited risk involved when you sell puts. Put selling is also known as naked put selling because the option is being sold outright without owning the stock, like covering the option. The opening transaction on a put sell is to sell rather than buy a put option. When selling to open a position, you are shorting. In this case, the trader is shorting the put. For those who are familiar with shorting stock, there are some similarities. A trader who shorts a stock is hoping that the stock price goes down. This trader has a short bias view of the stock. The stock going down is the only way he can make money on the trade. For put sellers, it isn't as simple as that. Put selling takes a neutral to bullish view of a market. That may sound contrary to shorting. If we short the option, aren't we hoping that the stock will go down? No. We are hoping that its option premium goes down. All the way to zero means the trade has successfully and completely played out. An additional benefit of allowing the premium to fall so low is that many brokers don't charge an option contract fee when the premium is at or below 0.10. What is premium? Every options trader deals with premium. When you buy a stock, the trade will become profitable when the stock price moves above your entry price. An option is a derivative of the stock. Instead of profiting directly from the stock price movement, the options trade profits on moves in the options price, which is called premium. Because we are shorting the put, we are hoping for the options price to decrease, i.e., we are hoping for the premium to decrease. Let's look at an example of a put selling trade. So let's say today is April 19th, 2021, and Microsoft is trading at 250. A put seller wants to sell puts on the May 7th 230 strike. The May 7th 230 put option is trading for 0.64 by 0.72. The trader puts in a limit order for 0.68 on 5 contracts. The order executes at that price. Over the next few weeks, the price of MSFT goes to 260 and then down to 240. The option premium dwindled to 0.35 by 0.40, creating an unrealized gain of 0.30, or 5 by 0.30 by 100 equals $150. If MSFT can stay above 230 by May 7th, the trader will capture full premium, resulting in a profit of 0.68 by 5 by 100 equals $340. Of course, the trader can buy the option back at 0.38, closing out the trade and making a little less profit. Does put selling have unlimited risk? No. The confusion in that statement comes from equating put selling with selling stocks short. Yes, selling stocks short has unlimited risk. Selling a put option on MSFT at the 230 strike is like selling MSFT stock at 230. Only the amount invested in the trade can be lost. On the other hand, selling naked calls does have unlimited risk. Selling puts far out of the money, far away from the current stock price, provides for a lot of padding. It allows the stock price to move around quite a bit. But selling puts far out of the money is very difficult. The difficulty comes from finding good enough premiums to make the trade worth it. Put selling is an income collection strategy. The upside on the trade is capped at the entry price of the option. Unlike being long a stock, a put seller can't participate in any upside movement of the stock. But for those who can find far out of the money options and have the patience to let their premiums dwindle, it can be a rewarding trading strategy. Hey, I hope you found that helpful. I know it can be kind of confusing with all the numbers, the math, and everything in a podcast. If you need to see it and kind of work through this yourself, you can find this article at thecollegeinvestor.com. Thanks again for stopping by today. Hey, we'll talk to you again real soon.